So when you try and save on business taxes by driving your profit down, I just want to show you how that, one, yes, can save you taxes for that year, but how it destroys the value of your business if you're planning to sell. Now, if you're not planning to sell your business, I guess this doesn't really pertain to you, but if at some point you do want to sell your business, I just want to show you how this really hurts the value of your business. You really want to have your tax returns showing just all business expenses and business profit. Now, a lot of small business owners, they'll weave in personal spending, personal cars, personal health insurance, running family vacations through the business at times. I totally get it. I'm not a CPA. I'm not here to talk about how you structure write-offs or save on your taxes for that year, but I want to show you as a business broker how that hurts the value of your business. So most business owners, when I speak to them, they all say the same thing, right? Well, we're making $4 million in revenue, but the tax returns, we don't show that because I don't want to pay Uncle Sam. I totally get it, right? I totally understand. And so here you have a good business, but they're driving their profit down on their tax returns so they don't have to pay as many taxes that year. Now here's what happens. When you go to sell your business, businesses are valued based off of a multiple of what they earn. And that earnings metric is going to be EBITDA, if you've heard of that, or SDE, which is seller's discretionary earnings. They're both fancy metrics of measuring profit in your business. So businesses are sold for a multiple of the profit, essentially, right? Now, obviously, you're going to add back if you're taking a salary out because you're no longer going to be there, so you can add that to the profit. But for the most part, businesses are valued based off their profit. Now, when you're driving profit down, you can't apply you're going to be applying a multiple to a smaller profit amount. But then you say, well, yeah, but it was my personal health insurance, and I have personal cars and personal meals and personal travel. We had a family vacation that we put it on the business card, right? Here's why that hurts. It saves you in taxes for that year, and maybe you save a few $1,000, $15,000 that year, which is great. And now when it's time to sell your business, the broker is going to run a valuation on your business, and they look at the last 3 years of your financials. So they'll ask you for your 3 years of profit and loss statements, 3 years of tax returns, 3 years of balance sheets. Now that's very common, going back 3 years, sometimes 5 years. So a broker's going to they'll look at the profit and loss statements, but they'll also match them up with the tax returns. Now the bank is going to be looking at your tax returns. The tax returns are the gold standard for the bank. And why is the bank important? Well, they give the money to the buyer to buy the business, right? And when buyers buy a business, when they go through this due diligence process, which usually comes after an accepted letter of intent, a rough draft offer, a lot of times buyers will pay for a Q of E, which is a quality of earnings. Essentially, it's an audit on your financials and your tax returns. They just are tracing all the money to make sure everything checks out and they're comfortable moving forward with closing on the business. Now, a quality of earnings report and the bank are going to be looking at the tax returns. Again, it's the gold standard. And so when you're driving the profit down on your tax returns for those previous 3 years, your profit's going to show significantly lower. And then you go, great, Jordan, so we're just going to add back all of those personal things and we're going to bring it back up to what it really was. Here's the problem. If you can't clearly prove it with documentation, the bank's not going to count it, right? Now, for some things you can with car. It's easy to pull your auto loans or your financing for your vehicles and show, here's what I pay, we ran it through the business, great, right? That one you can. Meals, travel, not so much, right? Because how do you prove that? If you have $10,000 in meals and entertainment, how do I know that was all personal, right? Maybe you did take some clients out for lunch, right? Maybe you did take some clients out for some coffee, whatever it is, right? You can't really prove that. It's a very hard thing to prove. So unless your CPA has immaculate bookkeeping for your business, maybe it's a little bit of a different story, but there are what we call add backs, those expenses, those meals, the travel, the family vacations, right? That are harder to prove. And even if you can prove them, most banks will only add back 50% of that amount. So now you're immediately losing value. And why that's important? Because like I was saying, businesses are bought and sold for a multiple of what they earn. And my job as a business broker is to show all of those earnings in your business because it helps increase the price of your business. You as the business owner, you want that earnings number, the profit, to be as high as possible. So then when you apply a multiple to that, you're just multiplying that number by 2, by 3, by 4, by 5. It gives you a higher purchase price, or selling price, I should say, right? Now, when you can't add back 50% of your meals or 50% of your travel, or there's other personal spending in the business that's hard to track with documentation, you can't really prove it. And, yes, it's true. We're not saying business owners are lying, but it's hard to trace the money. It's not all there. There's no documents or pieces of paper that show, hey, this was actually personal, right? It gets into these gray areas, and anything in the gray area is just simply not counted, right? And things like meals and travel, a lot of times banks just say, we're just going to take 50% of it, right? Because it's too hard to track. And so when you are cutting those expenses right in half, the reason why it's a big problem is because it's not that you're losing, $10,000, $20,000 off of those add backs or those personal spendings that you can't track. That gets multiplied. So instead of $10,000, $20,000, $30,000, it can get multiplied by 2, by 3, by 4, by 5, right? So if it's $100,000 that we can't track, we can't prove with documentation, well, it's not $100,000. It's multiplied by 3, $300,000, $400,000, $500,000 off of the asking price on your business. So as you can imagine, some business owners, they run a lot of personal spending through their business, and it's a lot more than $100,000. I'll tell you that. I've seen it multiple times. It can be $300,000, $400,000. Now that's getting up there, but if you have $300,000, let's say, of personal spending that you just can't quite pinpoint with documentation, or it's a little bit all over on your profit and loss statements, and then it's not showing on your tax returns, and your CPA can't reconcile it or show where it's coming from, and they're in that gray area of expenses like meals or travel or anything like that, where the bank's just going to slash it in half, well, then your price drastically drops, because if, like I was saying, $300,000 times 3, it's $900,000 off the asking price of your business. And there really is no other way around that unless you find a buyer who's not going to go through a bank, and you don't really see that too much in the small business space. So saving on taxes is great if you're not planning to ever sell your business and you're going to pass it down to a family member or something like that. But if you do plan to sell, at least start 3 years before you plan to sell and stop all the personal spending through the business, and really try and show the profit as high as you can on your tax returns. I know it sounds crazy, but that's what's going to really boost the value of your business. And yes, you're going to have to pay taxes on it for those 3 years, but it's worth making an additional multiple 6 figures on the time you go to sell your business, right? So if there's one thing I could say to business owners who do plan to sell, and you are running personal things through the business and maybe not tracking them as best as you think you could, give yourself that 3-year runway to really clean up those books, and talk to your CPA or your financial advisors or bookkeepers or whoever, that you want to make this as clean as possible starting now and going over for the next 3 years, so that when you go to sell your business, you can pull those previous 3 years and they're extremely clean. It's just business expenses. It shows true profit, and that's really, really going to help the value of your business. So if there's one thing I can leave you with, clean up the books, stop the personal spending, stop trying to push the profit down as low as you can for tax purposes, because you're going to make a lot more money when you go to sell your business if you do that.